Hello, everyone. Welcome to the webinar today. My name is Alexandra Alvarado, and I'm the Director of Marketing and Education here at the American Apartment Owners Association. So glad that you could join us today on this beautiful Wednesday. We are midweek here talking all about tax strategy optimization, wealth acceleration, all those wonderful things that we all want to do as real estate investors. And we've brought on with us our expert speaker and best-selling author, Tom Wheelwright. Thank you so much for joining us, Tom. Tom has been with us for a few webinars in the past and always brings us such great knowledge about really little known strategies that are, in my opinion, advanced. I think for a lot of investors where they don't actually find out about these strategies until way down the road. And so I'm so glad that you're here to listen to Tom. Tom is a CPA as well, so he has that tax background, but he's also a wealth expert, serial entrepreneur. He is more so just dedicated to the belief that everyone deserves to be financially independent of employers. And he really helps real estate investors in particular do that. And he's also a rich dad advisor. He's the CPA for Robert Kiyosaki. A lot of you may know him. And he's also an international speaker. And he's sold some amazing books like The Win-Win Wealth Strategy and Tax-Free Wealth. I have both of those books. They're fantastic reads. So just all that to say, you are going to have a great learning experience, and he has told me he's going to make it quite interactive. But while we hand it off to him, I also want to remind you that this whole thing is being recorded, and we will be sending you the recording tomorrow, as well as any sort of resources that we're going to be talking about today and Tom's contact information. So if you all have questions, him or his team will be getting back to you with some answers. And we will have time at the end here for Q&A. So please stick around for that. Put your questions in that question box that you see at the bottom of your screen, not the chat. That really helps us keep better track of all the questions. So again, question box. And then if you don't put them there, I'll try to tell you in the chat to leave them in the question box. So again, thank you so much for coming on to speak to our group. I really appreciate you having you back here, Tom.
It is so good to be with you guys. Alexandra, thank you so much for having me back. And I love apartment owners. It's part of the reason I love it is because just because the tax law has such great tax benefits, the tax incentives for apartment owners. But I want to start with a quick question. If you would put in the chat, this time in the chat, not in the question box, put in the chat. I'd like to know how many of you pay tax. And if you pay tax, type in pay tax. I want to see how many of you pay tax. Just type it in as fast as you can, as fast as you can, as fast as you can. How many pay tax? We have people all over the place. Judy and Eric and Yvonne. This is awesome. You pay tax. All right, keep putting that in. I pay tax. Oh my heavens. Think about how that feels. I pay tax. Oh my heavens, I pay tax. Pay too much tax. I love it, Sharon. I pay too much tax. How many of you would rather not pay tax? And if you'd rather not pay tax, put no tax, no tax, no tax. You want to pay absolutely zero tax, put no tax in the chat. This is awesome. Thomas and Jenny, no tax. These are no tax people. Bryant, no tax. This is awesome. I love this. I just want to say you guys are, I want to first of all, I want to thank Alexandra and the AAOA, but I also want to congratulate you guys for being here. There are a lot of people who say they want financial freedom, who say they want to pay less tax, but they're not here. You're here. And I want to congratulate you specifically for being here. So today, here's what we're going to talk about. You want to pay little or no tax. You're putting it in. No double tax. Here's somebody already pays very little. That's awesome. But Alan, you're here because you want to make sure you're continuing to pay no tax. This is awesome. It is not only for apartment owners. This is for anybody who is an investor. Anybody who's an investor. So, or anybody who wants to be an investor, frankly. what we're going to talk about today applies to single family homes, duplexes, fourplexes, apartment owners. Frankly, it applies to commercial property and it actually applies to other asset classes. But we're going to focus on apartment owners today. And we're going to focus on all sizes. We'll just call it residential is what we're going to focus on today. And we're going to talk about the tax. How many of you would like to build massive wealth? Put in massive wealth. If you'd like to build massive wealth, that's really what you want. You want that massive wealth. Nadia wants massive wealth. You want massive wealth because massive wealth is going to get you the freedom. As Alexander said, our mission in life, our mission at Wealthability and Tax-Free Wealth Advisors is for you to become financially free, not just of employers, but of the government and Wall Street. Okay, we want you to be completely financially free of those three groups so that that's when you have true financial freedom. You're not relying on anybody else. Massive wealth. We got Sam wants 50 million. Yes, freedom, massive wealth. Michio wants, people want, I love it. Philippe, you want freedom. That is what it's about. It's about financial freedom. And I'm going to show you today really how wealthy people become wealthy in the first place. Okay. So I'm going to actually show you 45 years of experience, thousands of entrepreneurs I've worked with and investors, and show you how they all do it, because they all do it the same way. It's none of them are lottery winners. Okay. They all do it the same way. So we're going to talk about freedom of time, freedom of activities. But let me give you, just for those of you who don't know me, a little of my background. Annie, I love massive wealth. A little of my background. So I grew up in Salt Lake City, Utah. I was a good Mormon boy. And as a result, I got to spend 2 years in Paris learning how to get rejected in French as a Mormon missionary. And then I went to school at the University of Utah, where I did my undergraduate, and the University of Texas, where I did my master's of professional accounting and tax. I spent 7 years with one of the largest CPA firms in the world, Ernst & Young, including 3 years in their national tax office. I spent 4 years as the in-house tax advisor for a Fortune 1000 company here in Phoenix, Arizona, where I live. I spent 25 years buying, building, selling CPA firms. And then I started developing a network of CPA firms, and more recently have developed a franchise of tax advisory, CPA-based tax advisory firms that specialize in working with entrepreneurs and investors. We specialize in tax planning for entrepreneurs and investors, and everybody's a CPA and everybody's an entrepreneur. So those are two qualifications we have. You must be a CPA, you must be an entrepreneur. So one of the other things that happened while I was in my career, couple of things. First of all, I taught for 14 years as an adjunct professor at Arizona State University. And while I was doing that, while I was building firms, I met a fellow by the name of Robert Kiyosaki. If you've read Rich Dad, Poor Dad, just write in Rich Dad. I'd like to see how many of you have read Rich Dad, Poor Dad. This is the seminal book for building wealth of all time. No book has ever sold more on financial freedom than Rich Dad, Poor Dad. Congratulations, you guys. And if you haven't read Rich Dad, Poor Dad, there are still copies available. It is still the #1 bestseller worldwide. Robert and I became friends. We have spoken in 30 countries, 6 continents all around the world. And one of the things that's interesting is wherever we go, somebody will come up to me at some point and they'll say, Tom, this is great. Really good information. You know, you can't do that here, right? So for the next 50, 60 minutes or so, how many of you are willing to put aside your doubts and just entertain the idea that maybe you too could build tax-free wealth? And if you do, just type in tax-free wealth. If that is something that is interesting to you, if that's something you'd like to learn how to build, type in tax-free wealth. TFW works. TFW Advisors is the name of our franchise, actually. So tax-free wealth. This is it's the book that I wrote, the best-selling book that I wrote. It's also what we are after, because what I'm going to show you today is, and what you're going to learn is that taxes are the biggest impediment to building wealth that you have. They are the single biggest impediment, and it's not by a small amount. We're actually going to run some numbers here. But when somebody says, I can't do that here, what I recall is the very first time I ever heard that, we were in Santiago, Chile. And if you can picture this, and if you've heard this story before, bear with me. But if you can picture this, we have a room of 600 people at round tables. On the right-hand side of the stage is a Bentley. There's a black Bentley. On the left-hand side of the stage was a lime green Lamborghini. And Robert, in his inimitable way, comes up to me right before we start. He says, Tom, today I would like you to explain to them how to deduct a Bentley. He was driving a Bentley at the time. I said, sure. So I get up there later that morning and I explained the rules for deducting an automobile. And I walk through it, and I'll give you a little bit of that in a minute here. But I went through the basic rules, and everybody responded well. And at lunchtime, a tax attorney from Santiago comes up to me and he says, Tom, I really loved what you're doing up there. Just understand that that's illegal in Santiago. You cannot deduct a car because it's considered a luxury. I said, okay, well, thank you. So later that evening, I'm sitting down to dinner with Robert and the other speakers, and I telling the story. And Robert just looks at me and goes, okay. Next morning, he gets up right before we go on stage, and he leans to me and he goes, Tom, today you're going to teach them how to legally deduct a Bentley in Chile. I said, okay, we'll do it. We will figure this out. And later that day, we got up, Robert and I together, and we actually took a completely different approach. Completely different approach. We showed them how to legally deduct the cost of a Bentley in Chile. At the end of the program, the same tax attorney came up to me and said, Tom, that was amazing. I would never have thought of doing it that way. It would absolutely work. So here's the lesson I learned. And some of you have read this in Tax-Free Wealth. And the lesson I learned is, if you want to change your tax, you have to change your facts. You want to write that down. If you want to change your tax, you have to change your facts. All right. So it was really a lesson to me, is that, you know what? Anything is possible. Anything is possible. One of the things I learned from Robert is how you measure wealth is an important question that you have to ask yourself. How do you measure wealth? Robert measures it in the number of days you can go without working. Okay, so if you're truly wealthy, then if you're truly wealthy, then you don't have to work, right? I mean, that is true wealth. You don't have to work. So let me ask you a question, because I'm seeing something in the chat that I'm just going, how many would like to be able to own a Bentley? Not own a Bentley, but would like to be able to own a Bentley? How many would like to be able to own a Ferrari or a Lamborghini? How many would like to have the freedom to own whatever you want to own? Put own it. Put own it in the chat. If you want to be able to own anything you want or have all the freedom you want, okay? Put own it in there. Philippe, you've got it. Bryant, you've got it. Sam, you've got it. Annie, you've got it. Gwen, you've got it. You want to own it. Okay. You want to, it's not that you want it. It's that you want the ability to have it. That's freedom, when you can own it, and particularly when you can own your own life. Okay. That's when you really have freedom, because what I think financial freedom and wealth is work-free cash flow. It is work-free cash flow. Now, somebody's already mentioning, what do you mean change your facts to change your tax? Okay, let me give you an example. Let's say that I've got, and I'll show you real quick. I'm gonna tell you the rules here real quick. Let's say you got this mug and you ask me, is this deductible? And my answer is, I don't know. I don't know if it's deductible to you. Now, this mug is absolutely deductible to me. Why is that? Because the way the tax law works is it's all fact specific. So there are 4 rules, and I'll put this up, I'll share my screen so you can see this. There are 4 rules in the US to deduct almost anything. Okay, now there are other ways to deduct besides what I'm going to show you, but this is 95% of the time. These are the rules. Number 1, you have to have a business purpose. Now, real estate investing is a business, as long as you're actually involved in it. But as a general rule, it's a business. So it has to have a business purpose. That is the easiest test to meet. Number 2, it has to be ordinary, meaning in your business and at your level, it is typical. So typical in size and frequency. Number 3, it has to be necessary, which means that the purpose of spending the money is to make it profitable. Here's a rule to write down. The purpose of an expense in a business is to create income. The purpose of an expense is to create income. If you want to look at your profit and loss statement, your income statement, and see whether your expenses are good expenses, challenge yourself. Does this expense actually make a profit for me? Marketing expenses are a really good example. If I'm doing an ad spend, okay, is it making me money? If I'm doing improvements on my rental property, is it making me money? So it has to be necessary. Number 4 is it has to be documented. So let me give you an example of changing your facts. If it's not documented, by the way, the IRS doesn't care about the other 3. Okay, but let me give you an example of changing your facts. Let's say you go to dinner with your spouse or significant other once a week. Okay, and you just have casual conversations and it's enjoyable. Well, if you, by itself, that would not be deductible because the rule is nothing is deductible unless you can prove it's deductible. That is the rule. Now, let's say that you actually have a business purpose for that conversation with your spouse. You're talking about your investments. You're talking about your business, not any investments, but particularly, let's say, your real estate investment. You're talking about your property. You're talking about, or your business that you own, if you own a business. In fact, if you would, type in, if you own a business besides real estate, type in business, would you? I like Nadia, own lots of it. Type in business. I'd like to know how many of you own a business in addition to real estate. Just type in business. Here's business as a gym, property management. Dorian has a business. Chitra, I'm sorry if I say your name wrong, has a business. Okay, type in if you have a business. Business actually is the #1 tax saving opportunity in the world, not just in the US. And your real estate investing can be a business under the tax law, but it needs to meet these 4 tests. So let's take your spouse, you're taking them to dinner once a week. Now, I can change my facts by having that business conversation. Does it have a business purpose now? The meal out with my spouse? Yes. Is that would be typical to run issues and questions by by somebody, even if they're not in my business. I don't care. It doesn't matter whether your spouse is in your business or not. Would it be typical to do that in a casual setting like a restaurant once a week? Yeah, probably is. Would it be profitable to do that? 100%. I talk about my business with my wife all the time. And it is so helpful to get that sounding board. Okay. They don't have to be stakeholders in the business, Dorian. They do not. Okay. Your spouse can be a W-2, you can be a W-2 employee. My first wife was a music teacher, but I found it so helpful to run business questions by her because she had a completely different perspective. She was a great sounding board. Now we do that and we document it: who, what, when, where, and why. Okay, that's what we have to document. We have to have the receipt, a scanned copy of the receipt. Guess what? That business meal is now deductible. Before, it wasn't a business meal, so it wasn't deductible. I changed my facts to change my tax. I changed my facts to change my tax. Okay, now I want to walk through an exercise with you. If you're willing to do an exercise, just type in yes, would you? Just type in yes if you're willing. I just need to know that you're fully engaged here and you're willing to do an exercise here. Oh, thank you, Matt. Thank you, Joel. You're willing really to do an exercise here. We have 140 people on this call right now, and you're willing to do an exercise. Okay. That's what you're willing to do. Okay. All right. So here's what we're going to do. Now do this with, try to do this without falling asleep. I would like you to close your eyes, and I'd like you to make sure you don't have distractions around you. So close your eyes. Just close your eyes. Couple of deep breaths in through your nose, out through your mouth. Now I want you to picture that you're in that one place where if you had all the money and all the time in the world, this is where you want to be. This is where you feel the best. It's where you're at your best. This is where you find the most joy. Picture it, even if you've never been there. Picture it in your mind. I want you to get a really clear picture of it. I need you to get really clear on this. Once you have that in your mind and you're picturing it, I'd like you to picture the people that you have around you in that perfect place. Who do you want there? By name, by who they are? Who do you want around you? Picture who they are. Picture exactly how you feel about having those people around you in that perfect place. Next, I want you to imagine what you're doing. I want you to imagine what you're doing and how it feels to be doing these activities with these people in this place. How does it feel? Now, open your eyes. I'd like you to write it down. This is critical. You want to know how to build massive amounts of wealth? You've got to have a goal for that wealth in the first place. You've got to have a reason for it. It is not easy. It's not going to be easy. It's simple. I'm going to show you how, but it's not easy. So I want you to write down very clearly where you were, who were you with, and what are you doing? Where are you? Where were you? Who are you with? And what are you doing? Now, I want you to write down when. When do you want this to happen? When do you want this to happen? How many, is it years from now? Put a date to it. So put today's date and put a date to it. In fact, tell you what, do this. So just draw this on a piece of paper. Okay, here's today. Here's your dream. And here's the amount of time right here. We're going to put time, right? So here's today's date. Here's the dream date, the amount of time. Okay. All right. Now for the tough part. That was the fun part. That's the easy part. Now the tough part. How much is it going to cost? How much is it going to cost on an annual basis to have this dream? How much money is it going to take annually to reach this dream, to have this dream, to own this dream? You might have a house payment on a beach house. You might have travel. You might have travel for you and for those people that you brought with you. But it's going to cost money. You know it's going to cost money. I want you to write down how much on an annual basis it's going to cost. Okay, just take a few seconds to do that. Just guess. Doesn't have to be perfect. So you're going to take the cost. You're going to take the cost on an annual basis. Then I want you to multiply it by 25. Now, why do I want you to multiply it by 25? Because when you're not working and you've built your wealth, you do not want risky investments. You want a risk-free return. And a 4% return consistently over the last 40 years has been a pretty good return. 4% return equals 25 times your cost. So let's say you wanted $200,000. Let's say the cost was $200,000 as an example. You multiply that by 25, that's $5 million. That's assuming you don't want to burn through your principal, because you don't know how long you're going to live. You could live till 150. You really could. That is becoming possible. You're going to have $5 million. Okay. Now we're going to do a couple more things. Bear with me. I want you to list what you have today. I want your financial net worth. Now this includes, I'm going to tell you what to put into this. It does not include your house, does not include your personal residence, does not include your boat, your car, doesn't include any of those. What it includes is the value of your investments. So it's your investments, which would include your cash. It includes your cash. It includes gold, silver, Bitcoin. It includes your IRA, right? Anything, it couldn't even include the cash surrender value of a life insurance policy, anything that's available to invest. Okay. Now, here's what we're going to do. I want you to go to this. I'm going to put it in the chat here. This is the website. I want you to go to, this is my website, wealthability.com/wealth-evaluator. Okay, I just put it in there. Let's see. Oops, I need to put it to everybody. Sorry about that. wealthability.com/wealth-evaluator. Go to that right now on your phone, on your computer. It doesn't matter. It'll work either one. Okay, there you go. And I'm going to show you. So this is what it should look like when you get there. It'll look just like this. Now, this is a really cool, it's a very simple calculator, really simple. It's just a present value calculator. It's nothing fancy. What I want you to do is I want you to put that your initial investment is going to be your current financial net worth. So let's say that's $500,000. That's the amount you have available to invest. We're not going to expect to add anything to it. Granted, you might, but we're not going to for this exercise. Let's put in what you think your average rate of return is. Let's say it's 7%. Okay. That's what you think the average rate of return is. Let's put when you would like it. Okay. In this case, it's 24 years. And because it's down the road, it's okay. I'm good. I want to see how, what I, I want to, I'm good. I'm going to take my time 24 years from now. Some of you might be 7 years. Some of you might be 5 years, whatever it is, put it in there. And then put in what your future cost of the dream is. So in our example, that was $5 million, right? It was $5 million because we want to get to $200,000 at a 4% interest rate. Now what you're going to do is click this, show me the required rate of return, and calculate what the required rate of return is to get there. In this case, it's 10%. Okay. If you've done it, put in the chat, got it. Got it. Okay. Put in the chat, got it. If you're able to do this, if you've been able to do this, go ahead and put in got it. I've got here's my rate of return that I need in order to reach my dream. Got it. Philippe's got it. Okay. Alexandra's got it. Okay. Take what your annual cost is times 25. That's your future net worth. Put that in the future value, put your years in, put your current financial net worth in. Andrea's got it. Bill's got it. Matt's got it. Eric's got it. Okay. If you've got it, write down got it. And now you've got a rate of return. That is the rate of return. That is your target. And right now, remember, when you get that, that should be your target on every investment. That is your minimum target. Some of you, it's going to range. And if you will, put in what your target rate is. In fact, put in what your target rate is, because I'd like to see target rates, because they're going to vary a lot. They're going to go from, my guess is 6% to 60%. But go ahead and put in your actual target rate of return. What's your target rate of return? What do you have to do? Rate of return, Bill, 7.9%. What do you have to do in order to get to your dream when you want to get there? Put in your target rate of return from the Wealth Evaluator. Okay. Andreas, 10%. Okay. Put in your target rate of return. Okay. I want to make sure you're getting this. I know doing numbers, 15%, 10%. William is 10%. Tina's at 15%. Put in your when you get it, put in that target rate of return. Philippa, 17%. Chitra is 14%. Put in your target rate of return. Here's the challenge. If we don't know our target rate of return, how do we know how to invest? If you don't know your target rate of return, how do you possibly know what to invest in? We've got to start with, see, here's the difference between an amateur investor and a professional investor. An amateur investor typically will make a new decision every time they invest. They'll make a new decision every time they invest. A professional investor, and I've worked with hundreds of them, professional investors make one decision and apply that decision over and over and over again. And one of those decisions is you're making right now. So congratulations. Eric's at 12%. Hungerford is at 11%. We've got 10%, 11%. This is good. Okay, now remember, we're recording this. So you can go back through this, and I suggest you do. I suggest you go back through this, and I would suggest you go back through this. Seth only needs 2.5%. Seth, I will tell you right now, you are there. You're good. You could literally invest your money in treasuries, and you would have your dream right now. So congratulations to Seth on that. Okay, now I'm going to show you, this is basically what you're going to end up with. I'm going to show this mostly so that you can see, it can be in the recording here. This is the formula. Okay. We call our wealth accelerator. Put in your number of years, your dream investment cash flow, your dream financial net worth, which is your investment cash flow times your risk-free rate of return, whatever you decide that is, it's up to you. Your current financial net worth, and then calculate with the wealth evaluator what that percentage is. Now I'm going to show you quickly the impact of taxes on that. Let's go back to the wealth evaluator. Let's say that, okay, so we're going to take Andreas. So this is actually takes 10%. So instead of 10%, let's say I want you to look at what's your marginal tax rate. You know what, before I do this, I want to show you how to calculate this next number. Hang on a second. I want you to calculate your marginal tax rate. This is a key number in your decision making. This is the highest tax rate. Now, for most of you, it's going to be 30% or more. And that means it's 30%, and it's whatever it is. It could be 20%, could be 30%, could be as high as 37%, plus your state tax rate. Let's say that's 5%. So if that's my marginal tax rate, it's 35%. Most state tax rates are in the 5% range. Now, I'm going to take that 35%. I'm going to take 1 minus 35% is 0.65 or 65%. If you're paying taxes on your investments, you're only getting 65% of the return. The government's getting the other 35%. You're getting 65, the government's getting 35. So here's what you do. On your calculator, right here, take that rate of return, multiply it by that 1 minus your tax rate. In this case, that'd be 6.5, right? We had 10%. We lost 3.5% to taxes. So now we're at 6.5. Now what I want you to do is go down here to calculate the real future value after tax. And your number now, instead of 5 million in this case, is 2.26 million. Instead of 5 million, it's 2.26 million. What does that mean to you? So if I'm now at 2.26 million, so now I have 2.26 million, 2,266,000. Now I'm going to multiply that by my risk-free rate of return. Let's say it's 4%. What does that end up? That's $90,000. If I didn't pay tax, it would have been $200,000. So you've lost, by paying tax, $110,000 a year because you paid tax on your investments. So write down how much you're losing because you're paying tax. Okay, now I'm going to show you the magic of how the tax law really works. Go back here. I'm going, okay. So let's look at what happens. Let's take a real estate investment, okay? And let's say current financial net worth of 500,000, but if I earned that and paid tax on it, it would have been 325,000, right? 35% tax, I'd end up with 325,000. My rate of return, 10%. Let's say my interest rate, 7.5. My debt to equity ratio is 4, meaning 80% loan to value. My rate of return on my debt is 10%. It's the same as the rate of return on my equity, right? That's my cap rate. I take 4 times the difference between the return on the debt and the interest rate on the debt, I'll end up with 20% rate of return. So this is how important debt is. You're literally, if you have that kind of a debt to equity ratio and that kind of difference between your cap rate and your interest rate, you end up doubling, in this case, doubling your rate of return. Except if you pay tax, you are doubling your rate of return, but you're doubling it from, in this case, 6.5% to 13%. What does it do to your future wealth? If you did not pay tax, you would have almost $40 million. If you do pay tax, you'd have $6 million for a difference of $33 million. That's at a 20% versus a 13% rate of return. The number of years, your future cash flow is almost $2 million versus $300,000. And reaching your dream is 9 years faster. Now, in the chat, if you want faster, if you want the 40 million, I want you to type in, I want that. I want that. Okay. I want that. I want the 40 million. I don't want the lesser amount. I don't want the 2 million. I want the 5 million. I want that. Okay. This is what you want. How bad do you want it? Are you willing to do what it takes to change your facts, to change your tax? Okay. Now, one of you said you don't pay 35% on all of it. No, but your investment income is incremental income, and you do pay it on all of your incremental income. So do not believe that you get to pay your average tax rate on your next dollar you earn. You do not. This is your life, people. Eric says, that is what I want. Eric, I can tell. Michael, you, Annie, Joel, Andrea, Tina, Matt, I can tell. You guys want this. Okay. If you want it, you can have it. Okay. Now I showed you how to make anything deductible, right? That's a simple deduction. But let me show you one other thing from a real estate standpoint. Most of you hopefully are doing cost segregations. Some of you are not. And if you are not doing a cost segregation on your property, and even if, by the way, so before we get there, somebody asked, why did I reduce the current net worth by 35%? The reason is because in order to get to that money, in order to save that money, you probably pay tax on it. Okay. We spend our first money, we save our last money. So we actually save our highest tax money. We save our highest tax money. We spend our lower tax money. That's really how it works. Okay. That's why the incentives for investing are so high, because the incentives are based on higher tax rates. All right. That's why I reduced it, because you would have paid tax on that. Okay. That's why I did that. But don't worry about that now. You've got your net worth. You know what it is. You're going to go forward here. Okay. Now, I want to show you cost segregation real quick, and then I'm going to show you one more slide, and then we're going to go to questions. Let me show you cost segregation 101. Now, cost segregation, look at it this way. The way I think about it, you've got a building here. But this building, that's not all you bought. When you bought this building, you also bought the land. You bought the land improvements like the trees and shrubbery, etc., right? Pretend that's a tree. Okay. You bought the land improvements. You also bought what's in the building. So you bought the cabinetry. You bought the ceiling fans, right? You bought the window coverings, right? You bought all that. A cost segregation is simply breaking out your purchase price between the building, the land improvements, and the contents of the building. That's all cost segregation is. You do need a professional. Okay. Do not do this on your own, and do not let your CPA convince you they can do it. They will lose at least half of the benefit, because engineers will come in and they'll actually get the wiring and everything else on here. Okay, so it's a much bigger deal. Let's say you do that. Let me give you an example of this. Let's say you had $100,000 and you go out and you borrow 400,000. So now, whoops, now you have $500,000. You buy a $500,000 property. You do a cost segregation. Roughly, let's say 30% is contents and land improvements, because those are the things that are depreciated faster than the building. The land doesn't get depreciated at all. Let's say it's 30%. It's about right, somewhere between 20 and 30% typically, depending on the cost segregation and the property. So that's 150,000. Okay. Now let's say that your tax rate's 33%. Average tax rate we said was 35. Let's say it's 33. That means your tax savings doing that cost segregation, if you get to deduct this is full deduction and what we call bonus depreciation. And I got good news for you guys. This is what we call bonus depreciation. This came into effect in 2017, 2018, and it started phasing out, and it's down to 40% right now. Let's say you had 100%, and I'm going to tell you why you want to think you had 100% in just a second. You now have $50,000. Well, wait a minute. What does that mean? Well, I could either, that means that I have an extra $50,000 to invest, doesn't it? Now, the reality is I could actually, I've really not, I have 50,000 I didn't invest, the government invested. So instead of, if my rate of return on this was 20%, which I just, or sorry, 13%, right? My rate of return, let's say it's 20%. It's 20%, right? Let's say my rate of return on my investment is 20%. But now I put in half of the money. What's my rate of return? It's just doubled. It's now 40%. You just doubled your return on investment by doing that. Now, what does it really mean? It really means that you could really go out and buy a $1 million property. I'll let you do that math later. But you really could go out and buy a $1 million property. Because on $1 million, you'd have twice this. You'd have $100,000. That's assuming you're paying tax. I get it. It's assuming that you're paying a lot of tax. But you'd have $100,000 and split this with your investors, right? You have $100,000 more now. Now you have basically $200,000 to put down, and you can do $1 million. Okay. So I know that's a lot, but that is cost segregation in a nutshell. And I'm going to show you one more thing here. I'm going to go back to the slide, and I'm going to show you, you know, I'll ask all your questions in a minute here. Some of you have seen this before. Hang on. This is a favorite of financial planners. This shows compound interest. It says, look, if you had a 31-day chart and you doubled you started with a penny on day one and you doubled it every day, by day 31, you'd have over $10 million. Now, let me tell you the fallacy in this. That is true, but the problem with that is if you're looking at what a typical financial advisor would tell you, they're going to use a 7% rate of return. You're going to lose 1% in taxes. You're going to have a 6%. So using the rule of 72, day 31 is year 312. So let's do a reasonable calculation, because nobody yet is living to 312. Let's instead look at it this way. If I'm at a 7% rate of return, ignore tax right here, and I'm a 7% rate of return, I can double my money 3 times. realistically in my lifetime, my work lifetime. I can go from $10,000 to $80,000. I can double it 3 times, 10 to 20, 20 to 40, 40 to 80. If I use debt and double my return because I'm using debt, by year 30, I get $640,000. 8 times if I don't use debt. I'm going to tell you something about debt. I want you to write this down. The purpose of debt is to buy an asset. Purpose of an asset is to create cash flow. The purpose of debt is to buy an asset. If you're afraid of the debt, it's because you don't trust the asset. If you're afraid of the debt, it's because you don't trust the asset. All right, you use debt, you're at 640. If you're not paying taxes and now you're at twice that rate of return, you're at 40 million. Notice it's very similar to the previous chart. You're at $40 million. That is the power of not having to pay tax. Now, I'm not suggesting any of you will ever not pay tax that you owe. You need to pay the tax you owe. This is legal, moral, and ethical. Now, I'm going to tell you the great thing about cost segregation and bonus depreciation. I predict it's coming back at 100% as of the beginning of this year. It is on the table at Congress. It is likely to happen, more likely than not to happen. We're going to get 100% bonus depreciation back, okay? Now, some of you are concerned about cap rates. I would encourage you that you're telling, what you're saying if you're worried about cap rates is that that you can't do that here. Somebody is doing it. Investors are still successful. Now, this is why I teach, because I teach tax strategy, but in order to reduce your taxes, you need to answer 3 questions. The 3 questions are, how do I make my money? So we can reduce the tax on the money you make. For example, if you make your money in a business, you could be at earned income rates, which means you're paying Social Security tax on all of your income. That's a Schedule C. We change our facts by making you an S corporation, and now you lose 15% taxes. Now we have to pay some in self-employment tax, but we can cut that self-employment tax in half. That's looking at how I make my money. The second question is, what are you going to do with your money? That includes the cost segregation, includes how you invest. The third question I rarely see anybody address, which is, what are you going to do with your money when you die? Unless you're my age or older. People aren't looking at that. I would suggest if you're 30, you ought to be looking at it. What do I do with my money when I die? And the reason is because what you do with your money when you die, how you invest your money, and how you make your money all have a major impact on how much tax you pay. And we just saw, by the way, if you'd rather have the 40 million, just type in 40 million. If you'd rather have 40 million than 80,000, just type in 40 million. I want that. I want the 40 million. That is what I'm ready for. 40 million. Can you handle 40 million? I would tell you, most people can't handle 40 million, but you're here. You understand that education is more valuable than a Bentley. It's way more valuable than a Bentley. Now I can actually show you, and in fact, in Win-Win Wealth, I actually show how a client got the government to pay for his Ferrari. So I can show you how to do that if that's what you want. You want the Ferrari, you want the Bentley. But I think most of you want the 40 million because you want the financial freedom. That's what I'm hearing from everybody. Okay, if you want 40 million, what's that worth to you? Would you choose a car that wears out, say a $50,000 car that wears out in 5 years and you're not going to have, or $50,000 of education and strategy that you will have forever? Who wants that? Who would rather have the opportunity and the knowledge to make $40 million rather than have a car? So Kabuki asked the question. That's all great information. I'm not good enough. Is there education resource. Yes. And I'm going to tell you the education resource. Okay. Now, first of all, Alexander, would you put in the first poll, which is how many of you would like a free copy of my real estate investors tax strategy playbook? It has 7 proven steps to reduce taxes and increase profits from your rentals. If you mark yes, then we will get you the free playbook. Maybe it's yes, and I'm also interested in more in depth. Okay, then that's the accelerated program, which I'm going to go over in just a minute, or no thanks. Whatever you want is fine. Okay, just go ahead and answer the poll and we will get there. Okay, we will actually get this over to you. All right, now. All right, I'm going to go to the, let's give it just one more second. Okay. Yes, I believe, Sandeep, cost segregation will go back to 100% as of the beginning of 2025. Okay, I do believe that. Okay. Hungerford says, I became who I am through education. I'm all for it. Okay, if you are all for it, if you understand that education is more valuable than a car, than a Ferrari, if you understand that value, then that is awesome. William, good for you. That is fantastic. Okay, so good for you guys. Okay, now I'm going to show you one more. I'm going to share a slide with you. I'm going to walk through, hang on a second before I do this. There we go. And I'm going to walk through, we just launched a new program. And I want you to think about, let's say that you were, let's say you're in high school. Go back to when you were in high school. And you go, and 10 minutes before, it's your senior year last day, 10 minutes before the bell rings, the principal comes in, says, hey, just want you to know that we have an opportunity that we're going to take a few students who want it, who really want it, and are willing to devote themselves to it. And we're not going to train them how to get a job. We're going to train them how to never get a job. We're going to train them how to be financially free within a few short years. But here's the thing. There's only a few slots available. In fact, it's a class of 40 people and 20 slots are already taken. So there's only a few slots left. Now, if you wouldn't walk, but you'd run to that, type in run. I'd run to that, and type in run in the chat. I would run to that. If that's something, if you care about it enough, you care about your dream so much that you would run to that class, and because you'd want to be first, because you want to make sure that you qualify and you apply and you compete, you're competing with everybody else to get in. What are you going to do? How are you going to get there? What are you going to do to get there? What are you going to do to get there? So here, this is our Wealth to Build Accelerator. This is the first time ever we've done this, where I personally take 40 people. And like I said, 20 in this is true story. 20 are already full. We started, we started, but you can join at any time. It's a 1-year program. You have to be fully invested. You need to really want to change your tax. And because I'm going to show you how to change your facts, you need to want that 40 million. You need to want that freedom because you are competing. There are 200 applications we're looking at right now. We've accepted 20 so far. So if you want to get in, you need to click on this now, scan it now. Alexander's also going to put in the chat. She's going to do another poll. She'll actually put the link in the chat. Here's what we do today, just today. Okay. We'll give you $1,000 discount. We don't give anybody a discount on this. There's no reason for a discount because we have 200 applications, but I promised Alexandra we would give you a deal. So $1,000 discount. Okay. If you want it, just click yes on the poll. Okay, this is our accelerator program. This is me personally. In addition, let me tell you a little bit about the program. Our tax-free wealth advisors who are all qualified CPAs and been working in our system for several years. They're going to be your program advisors. On top of that, we're going to use our Wealthability Roadmap software. So you will have full access to the software system. On top of that, this is 4 days live. So once a quarter, it's live for a day in Tempe, Arizona. And 8 times a year, it's virtual, 2 hours virtual. During that year, you will actually develop your own wealth and tax strategy. You will develop your own wealth and tax strategy. I promise you will develop it. I've had advisors, not my advisors, I'd say about 90% successful. I have not had that. I promise you, we will develop that strategy. Now, you're going to have to implement it. If you want to change your tax, you have to change your facts. I cannot change your facts for you. I can tell you what facts change. I can explain how to do it. I can make it simple. We'll have fun with it, make it understandable. We played a game last time. Okay, we actually had our first one live day last week, and it was super successful. Again, we went ahead and started with 20 people. We have 20 more slots. That's it. We have our full set of online courses in our software. We have a learning management system, 25 courses. This is the fee we charge is 85% off of my normal fee. When I do a strategy one-on-one, this course is 85% discount off of that one-on-one fee. Okay, it's about the same as if you hired one of our tax advisors one-on-one. Okay, they're about 85% discount off my normal fee too. Okay, I don't take a lot of clients. I take 2 or 3 a year. This way I can have 40 in a year, and I can walk you through the strategy. Next month, in fact, this month, we're going to evaluate your tax returns, and we're going to teach you how to change the tax rate on your current income. We're going to teach you how to lower the tax rate on your current income. Okay, so we're going to do those 2 things this month. So if you're interested, just scan this, go to wealthability.com/accelerator if this is interesting to you, and we will take you through the whole tax strategy. We'll look at not just deductions, changing the nature of your income. We're going to look at your entity structure, what type of entities you use to own your properties. Okay. So Nick's asked a question. Have you learned proven tax optimization? Yeah, I just show you how to maximize your cost segregation. Okay. This is how we turn tax liabilities into wealth building. We use the tax law. We change our facts to change our tax. That's how we're leveraging the tax law. We've just gone from $80,000 to $40 million. That's how we leverage the tax code. Okay. Now, you want more? Your choices are simple, and I don't care which one you take. Seriously, totally up to you. You want the free, get the free. Okay. You want to go all in, then go all in, but do what you want to do. Do what's important to you. Okay. In the meantime, we're going to answer questions for the next 30 minutes, and I will take any tax questions you got.
All
You
right.
there, Alexandra?
Yeah, sorry, I lost sound for just a moment. So thank you for that. So we have Andrea here on your team has just posted the special offer link in there as well. So Sam are asking for a course outline, those kind of things. I think, by contacting your team, we can
Correct.
get some more information there. So we'll provide that in the follow-up email as well. And that will also have the recording. We did get some interesting questions that I wanted to touch on before we let you go. So the first question was, and I believe you might have answered it, but just to be clear, can you do cost segregation on a property that was purchased years ago, or can you only do it upon purchase?
You can. You don't get bonus depreciation. However, here's what happens. Let's say you bought a property 5 years ago. Okay. And you did what most accountants do, which is 80-20. You put 80% to the building, 20% to the land. That is what I see 90% of the time on tax returns that we didn't prepare. Okay. That didn't do a cost segregation. Now we go back and we decide, we figure out 20% of that purchase price should have been in that 5-year property. I've been depreciating over 27 and a half years. I should have depreciated all by now. It's 5 years down the road. Guess what? The difference between what I should have depreciated at under a cost segregation and what I actually depreciated is a deduction this year. And by the way, you can still do this for 2024. So if you haven't filed your tax return yet, you can still, so file an extension, do your cost segregations, and then take the depreciation catch up. Okay. It's Form 3115, do a depreciation catch up, change of accounting method, and you're going to do a depreciation catch up, and you get all of that catch up in 1 year. And not only is it okay, it is actually under the law, you're supposed to do a cost segregation. So this is not an aggressive thing to do. This is a conservative thing to do. What you'll find as you understand more of the tax law is the more you understand, the less tax you pay and the more conservative you get, because you don't have to be aggressive because you understand it better.
I like that. That is so true. Also, cap rates here, someone said cap rates generally are about 7% these days, if lucky. Some markets are only 4 to 5%. They didn't really have a question, but I just wanted to throw that comment out to you. If that's what you're seeing,
Can
what do
I
you
just
think
show
about
you?
that?
Well, so can I just show you how to change your cap rate real
Would
quick?
love to see that. I think I've seen it before, Tom.
I'm going to show you how to change your
Let's
cap rate.
see.
Okay. Let's say that you've got $1 million property. And let's say your cap rate 6%, right? So that means that your net operating income is $60,000. Only problem is your interest rate on your debt is 6.5% if you buy this today. So you're underwater. You do not want to, if you can't change your cap rate, you don't want to change this. But remember that cap rate equals net operating income divided by price, right? So in this case, it's 60,000 divided by 1,000,000. Most important number in real estate is your cap rate, and that equals 6%. Now I have two ways to increase my cap rate. The first is reduce my expenses. If I reduce my expenses by $10,000, then I just gone, so I have $60,000 net operating income. I reduce my expenses by $10,000. I just added $10,000 to my net operating income. Now let's say I improve the property. So this is cost reduction. Now what I do is I improve the property so that I can charge $10,000 more in rent. That's only about $200 a month, by the way, per unit, if this is a fourplex. That's not that hard to do. Okay. And by the way, I would reference you to Ken McElroy's book, ABCs of Property Management. He'll show you exactly how to do this. Okay. Now that is rent increase because you've improved the property. Now you're at $80,000. Now what's your cap rate? Now your cap rate is 8%. Now guess what I can do? Now I can borrow because I've got a 6.5% interest rate. So my interest rate, if my interest rate is 6.5%, that means at 80% loan to value, or we'd call that a 4, your debt to equity ratio is 4.0 debt to equity ratio. Then that means that my return now has gone from 6% and it's gone all the way up to 14%. Because I'm making 8% on my money and I'm making 1.5 times 4 or 6% on the bank's money. So now I got a 14% return instead of a 6% return simply by reducing my costs. And what I'm saying is the cap rate right now on the property might be 7%, but that doesn't mean you can't make it a higher cap rate by things you do to the property. This is what I've learned from Ken McElroy. And Ken's master investor. He's got like 15,000 units. That guy's a master investor. This is what I learned from him. Here's the other thing. Now you do a cost segregation, we get bonus depreciation. Now we multiply that by 2. Now we got 28% return on a 6% cap rate property. I don't know about
Amazing.
you, Alexandra, but I kind of like those numbers.
I love seeing that formula in action, and I think it's so powerful. And when we talk about in a lot of webinars different tools to increase rents, I think what some people don't realize is how much of an impact it has. Some people think, oh, well, I can only raise the rent 20, 30, $40 more if I add X, Y, or Z. But if you have, even just a few units, that really can drastically improve the cap rate. So all great stuff. I'm glad that you showed that. Also, too, a couple other questions came in about that bonus depreciation. Someone was asking if it's the same as the SEC 179 deduction.
No, no, actually, SEC. I don't know what SEC means. Section 179.
Section, yeah.
Okay.
I think
Section,
I read
no,
it like that
no, it
because it
is
was all in
not.
caps.
Okay. So 179 deductions don't typically apply in real estate investing. Okay. They're for business. If you look up section 179, it's in the Internal Revenue Code. We actually we don't use section 179 much, except for a small business. The reason is because if bonus is 100% and section 179 is 100%, bonus is better. And it's better because the recapture goes away. And it goes away incrementally, whereas with 179 deduction, it doesn't go away until it's until the whole life is gone. And if you change how much is business, et cetera. So generally speaking, if bonus and 179 are the same, bonus is better. Right now, bonus is 40%, 179 is 100%. If you can take 179 can be better. However, in rental real estate, you typically cannot take section 179. So bonus is actually pretty much always better when you're talking about rental properties.
Great. Thanks for clarifying that. Also, too, someone mentioned as a comment that you don't pay tax on all income at 35%, and it is tiered. So if you want to add anything
Yeah.
else to
So
that.
yeah, let me explain this though. The last dollar of income you earn is taxed at the highest rate.
Mm.
And the first dollar you deduct is deducted at the highest rate. So what that means is that for practical purposes, your investment income is the last income you earn. And if you can have that not taxed, that's going to be not taxed at the higher rate. On top of that, and on top of that, if you get the deductions, say for cost segregation or your meals or travel or any of these education, for example, by the way, yes, the government is willing to pay your tax rate times the cost of our accelerator program. They are willing to reimburse you for that. That should be deductible. In fact, we will make sure if you're in this program, we'll show you how to make sure it's deductible. So therefore, whatever you're paying for the program, right, should be deductible to you. And now the government's giving you a 35% discount if you're in a 35% tax rate. Okay. But remember, but anything you deduct comes off the top. It comes off the top. Anything that you earn in investing goes on the top because your base income is going to use up all the brackets. Your salary, your business, that's going to use up your brackets, right? Your investing typically is at the top.
Got it. Okay, that makes sense. Also, someone asked here if there's a recommendation that you might have as to how to find a cost segregation service.
Yes. There's actually some really good ones. We actually have we have a list of people that we use. Do you have a list of people you use, Alexandra?
I have a few recommendations that I usually give people, but I'm sure yours is much more comprehensive.
So we have a really good list that we share with our with people that are in our program, and we're happy to share them. If you want to inquire, you don't have to buy anything. But if you want to inquire with our team, they will share that information with you, who we use. Okay. Happy to.
Great. Great. Someone was asking if there's a way to get that cap rate formula, or if there's a calculator you have on your site for it. But it is a simple formula. I think if you watch back the recording, you can probably go back and do it. But do you have another resource, Tom?
Yeah, I'm going to make it really simple for you. Okay. So this is one you should memorize. Okay. So first of all, the basic cap rate formula is cap rate is equal to net operating income. That's income before your debt service. Okay. Net operating income divided by price. That is the definition of cap rate. All right. If your price, if your net operating income goes up, guess what? Your cap rate goes up.
Mhm.
If your if your cap rate goes down, your price goes up. So what happened in the 2010s was we saw interest rates come down, which meant cap rates came down. And by the way, I'm going to say one thing about this idea of cap rates. There are 10 cap rates out there. The sellers just don't, the owners of the property just don't know they're at a 10 cap rate. They think they're still at a 5 cap rate, but they're not. Okay. So that's going to happen. We're going to see it this year. I think we're going to start seeing this drop in prices because we're going to see this forced increase in cap rates, because having cap rates in excess of interest rates makes no sense. It makes no sense. It should never happen. In fact, I will tell you, it's just a timing issue in the market. It's because sellers have not given into the idea that their property is worth less than they paid for it. But that doesn't mean it's worth what they paid for it. It just means that they just don't know, they have not accepted that reality. And it's a tough reality to accept. But we're starting to see properties go back to the bank. We're seeing properties, we're seeing properties need capital calls all the time. We're seeing properties just being sold for a much lower cap rate where people are just trying to get out from under them. You're going to see those cap rates go up significantly this year. I suspect by the end of the year, your cap rate's going to be higher than your interest rates.
Yes, it's an interesting time in the market.
Yep.
Davis was asking here, does bonus appreciation remove or
Oh,
no future tax on recapture appreciation?
so a couple of things about that. Okay. First of all, the depreciation life is the actual life. In other words, if you have a 5-year ceiling fan and you hold the property, you've done your cost segregation, you hold it for 5 years, there's no recapture at the end of 5 years. Those contents are now worth zero according to the tax law. Whether they have value or not, according to the tax law, they're worth zero. So there is no recapture. Second of all, recapture on the improvements, there is recapture, but it's at 25% maximum tax rate, not 37% maximum tax rate. So you're still better off taking, if you're in a 37% tax bracket, taking the deduction now and paying the recapture later, because you get a 12% swing in your tax rate. So, and I would encourage you, open your mind. And if you've got people around you whose minds aren't open, find people whose minds are open like yours are. You're here because you've got an open mind. You're with AAOA because you've got an open mind, because you want to learn something different. You want to do what everybody else does. If everybody else was doing it, then there'd be no opportunity. It's because it takes effort that there's opportunity. So that's actually a plus, not a minus.
It's a good way to put it. And the next question here from Karen, a rental home of mine has a lot of accumulated unallowed loss. If I switch this rental home to my second home for a year, is that a good or a bad idea?
That's a well, it's probably a nothing idea. Here's what I'm hearing is that's probably a passive loss. That's what I'm hearing. So we've got passive activity, and we're actually in our accelerated class in 2 weeks, we're going to go through passive losses and how to use them. Passive losses carry forward forever until the property's sold or you have passive income. So if you turn your second home and you're going to keep it for your second home forever, you're not going to get that until you have passive income. Now, you could have passive income from anything else. Okay. So you could still free it up. There's still an opportunity there, but I would sit down with your tax advisor and walk through that and run the numbers. The key to everything, the reason I did the numbers on your dream is because if you don't have the numbers, that's where you're going. Okay. It's like Alice in Wonderland, right? She gets to a fork in the road, meets the Cheshire Cat. She asks, which road should I take? And the cat turns to her and says, where do you want to go? And she goes, I don't know. And he goes, well, then it doesn't much matter which road you take, does it? We set targets so that we know what road we're going to take. We know our investment rate so that we know what road we're going to take. Because guess what? Investing for a 15% return is a very different type of investing than investing for a 5% return. They're a different type of investing. And if you want a 30% return, that's yet still another type of investing. So understand that it's all about your education and how good of an investor you are. It has nothing to do with the investment. It's all about the investor. I'm sure you found that, Alexandra, over your years.
Yes, that is definitely true. And that's why we see investors succeed in all cycles of the market, which
Yep.
just changes all the time, yet still, we see success. There's a reason why investing never stops. Karen is asking here, sorry, that was Karen Kabuki was asking, I did a cost segregation and wanted to sell the property a year later. And I was told that I would have to pay recapture tax. How long do I need to wait to sell?
Yeah, you would in a year. If you knew you were going to sell it in a year, it may not be the best answer because you will. Here's the thing. So remember, you're recapturing two things. You're recapturing the contents, right? The price of the contents. And you're not recapturing all of it, right? If you held it for a year, you're only recapturing 80% of it because you held it for a year. It's actually not even 80%. It's like 68% is what you would recapture after a year. And that would be at your ordinary income rates. However, the improvements that you took bonus on, those are recaptured at 25%. They're not recaptured at your highest tax rate. They're recaptured at a lower capital gains rate, special capital gains rate for recapture on real estate. So you could still be better off doing a cost segregation. I typically tell people that if you're going to hold it for 3 years or more, you should absolutely do a cost segregation.
Yeah, yeah, I've heard that as well. Another question here from Donald. He says, I'm ready to retire and I want to sell a fourplex that I
Okay.
purchased in 1990. And I want to
Awesome.
use those funds to pay off the two debts I have on another house that I own
Okay.
and make it debt free. Now, if I lived in the fourplex in one unit and I keep renting out the other 3 units and sell the fourplex, do I get to claim at least a quarter of the fourplex as a main residence?
You do. You do. So you get that $250,000 or 500 if you're married. You'd get that exemption, that exclusion with respect to the quarter of it for sure. I get because I'm most people my age are retired already. Okay. So I get where you're coming from that you have a different view of, you might have a little different view of debt. I would challenge it a little bit because if you want to keep those properties, that's fine. Just remember, you're going to pay tax on that and you're going to lose that money. An alternative is to do a 1031 into a less risky property like a triple net lease.
Mhm.
Okay. Like a Walgreens or a Safeway or something smaller like a Wendy's. Okay. If you can do a 1031 into a triple net lease, because remember, it's any investment property for any other investment property, and you can take it from a residential to a commercial. Okay. So if you go ahead and do a triple net lease, remember they're paying all the expenses. You're guaranteed the rent. And if you fix your loan and it's less than the rent, than the cap rate, right? It's got to be less than the cap rate. But as long as that's the case, you really don't have any risk. And in fact, in a lot of those cases, it's a non-recourse loan, meaning that they're not going to come back to you anyway. They'll just take the property. I would just challenge, okay?
Mhm.
I just want to always challenge that thinking. I get the inclination to want to pay off debt. I get it. It's like at our core, safety first.
Mhm.
Our it's our reptilian brain, right? We want to protect ourselves. I just I would suggest, first of all, play Robert Kiyosaki's cash flow game, the cash flow game. Play it 20 times. Get a little more comfortable with debt on paper, and then look at other alternatives where it's not debt that could take you down. Because I get debt's a two-edged sword. I totally understand that. I'm not suggesting it isn't. But if it's the right kind of debt, it can really have a positive impact on your well-being and end up not paying tax at all, even though you have a very safe asset. So just another
Mhm.
way to look at it. That's all.
Yeah, yeah, yeah. And we've had quite a few Delaware statutory trusts sort
Yeah.
of
Mm-hmm.
speakers come
Been
on, and
through.
so
Yep.
that could be a good option.
Yep.
Um, Sam was recap a few things here. Oh, well, Donald, if you don't want to do a 1031 exchange, you can still do a Delaware statutory trust. You don't have to do
Right.
a 1031 exchange to invest in a DST. That could be a way for you to, invest in something with
Well,
like
and,
some
and,
of them are
and
pretty low, like 100 grand
I
or
just make,
less.
I would just make sure that
Mhm.
they're going to do a cost segregation.
Yeah,
Okay. Because
absolutely.
you would be, Alexander, you'd be shocked, I'm sure, at how many top tier syndicators do not do
Mhm.
cost segregations. They're top
What a
tier.
shame. That's
And
so
I'm going, you
surprising.
are just hurting your investors. Let's take worst case scenario. You do a cost segregation and it's passive, so you don't get the loss right now. But let's say you sell the property 5 years down the road. Your capital gain, because by then you don't have any recapture, right? So your capital gain is going to be a maximum 24%, 23.8%, but your loss is going to come off your ordinary income at 37%, upwards of 42% with state taxes. So you're trading, so you're getting a 13% swing if you do a cost segregation, even though that 13% swing may be down the road. So just be careful. A lot of them don't do it. And to me, it's a sin. It's
I
awful.
didn't even know that it wasn't being done until you told me, Tom, and I was so shocked to hear that because I thought it was just an automatic thing that they would
Right? Why
do.
wouldn't you do it?
But yeah, so surprising. So definitely ask whoever you're investing with if they're doing that. Also, too, another question came in about how do you think about buying my investment property, or what do you think about buying my investment property using an SDIRA?
Oh, okay. So I don't want to end on a downer. I don't like putting tax shelters in other tax shelters.
Hmm.
And an SDIRA is a self-directed IRA. And the challenge is you lose two things in a self-directed IRA. Well, three things. First of all, you lose control because you cannot control that investment. You can't make decisions other than investment decisions, because if you do, it's a prohibited transaction. You've blown your IRA. Second of all, you lose a lot of your ability for debt. And we just looked at why debt's so important. And you lose all the tax benefits, all of them, 100% of the tax benefits you lose. So I just don't get it for most people. And if you're going to be, by the way, if you can be a real estate professional, or your spouse can be, and you can get that benefit right now, remember, you're only paying if you reinvest that money. If you take the money out of your IRA, reinvest it into real estate, and you get to use those losses. The only thing you're giving up is the 10% penalty if you're under 59 and a half, because you're going to pay tax on it anyway. And in this case, you wouldn't pay any tax because you're going to reinvest it in real estate. You're going to get deductions in the real estate to offset the IRA income. So run the numbers. Always run the numbers. Sit down with your
Mhm.
tax advisor, run the numbers. Go to tfwadvisors.us if you need a tax advisor. That's the easy button. Or read my book. Chapter 23 is on how to find a good tax advisor in tax-free wealth. But make sure. So somebody says it's difficult to get the REP through the IRS. I'm sorry, but I've never had an issue with it. Not
With
even
the
once.
real estate
The real estate
professional,
professional,
yeah,
they will
status.
always challenge it. But I'm telling you, in our accelerator class, I'm going to show everybody exactly how to never have that issue with the IRS because I've been under audit. I've had clients under audit. I mean, that came into play in 1993. Okay. The real estate professional. And I've had clients audited over the years, and I have, knock on wood, never lost that issue. That doesn't mean I won't, but I'm pretty careful about what my clients do. So you can win that. I'm going to give you one last secret, and then we can let everybody go.
Okay.
You want to be not. Who would like to not be afraid of the IRS? I want to not be afraid of the IRS. No IRS. Just type in no IRS, no IRS, no IRS. Not
So I'm
afraid,
not
not
the
afraid,
only
not
one who
afraid.
gets nervous every
Okay.
tax
No
season.
IRS, no IRS. Okay. Here's what I want you to do. You write this down. I will never speak to the IRS. I will never speak to the IRS. That is not your job. That's my job. Why would you want to do my job? Let your tax advisor do their job. They're the professional. If you don't trust your tax advisor, find a new tax advisor. But I'm going to tell you that is one of the most important aspects of a tax advisor is that they know how to handle an IRS audit without you ever talking to the IRS because they're professionals.
Hmm.
Why not have a professional do it for you?
Yes. Okay. So many good questions. Everyone, we are sending the recording to you. It does include this Q&A portion as well, so you can play it
Great.
back, pause it, look at the formulas that Tom put up on the screen. And also, too, we'll send you all the links over to the Accelerator program. If you wanted the book and you said yes, Tom's team will be reaching out. So we're going to handle all that in the next few days for you. So sit tight. It's coming all soon. Thank you so much for spending the time to be here. And thank you, Tom, as well, for spending extra time with our group and really going through some of these questions. You are a wealth of knowledge, and I'm so glad that you were able to do this today. And hopefully you'll be able to come back soon. And I also just want to do a quick plug for our next week's webinar, which is actually a panel webinar. It's going to be how to find, finance, and rent out your next multifamily property. So
Nice.
we'll be learning a little bit, touching on what you did, Tom. Like, how do you expand in this market? How do you expand and do it in a way that you feel comfortable with? And the option isn't always just to sit on the sidelines. There are opportunities. So we'll have a broker there. We're going to have a lender and a remote investor who also coaches her students on how to remotely invest. So all of that coming in the email invite, or sorry, the email follow-up, which will have the invite in it. So thank you again, Tom. This was fantastic.
Thank you. And thanks everybody for spending your time with us talking about tax and wealth and really taking ownership for your own success. I am so impressed that you are here instead of doing something else. Thank you. And thanks, Alexander, for all you guys do at AAOA. You guys are amazing.
Thank you. Take care, everyone. Have a wonderful day. Bye.